All of this new demand, all the infrastructure builds really going to put a focus on local regulation, local economics. Not every utility is going to win. And there's going to be a lot of focus on which utilities can work with a lot of different stakeholders here. You talk about working with Microsoft, Google, Amazon. That's one customer for utilities. Those data center builders, developers, users, that's a customer. That's a very large customer.
What's the best utility stock for you to buy? We'll get to that in a minute. But first, utilities have really been at a crossroads. They had high rates, which is bad for utilities for a long time. They've risen recently on the prospect of lower rates and on the fact that the U.S. has had pretty good demand growth for the past, or recently has entered a period of electricity demand growth after 20 or almost 30 years of very, very low demand growth. But who will be the winners and who will be the losers? My guest here is Travis Miller, Morningstar Energy and Utility Strategist, and Travis is going to help us unpack this. So, Travis, welcome.
Thank you.
Great to be here with you, Travis. I'm looking over here at my questions, my notes. Data center demand is just 3%. We've seen all this hype about data centers and the new data center this, data center that. With AI, it's all the buzz, and of course, it's bled over into the utility space. But the data center demand is just 3% of U.S. electricity demand, which is not nothing, but that's kind of tiny, relatively speaking. And you're forecasting U.S. electric power growth of 1.4% annually for the next 8 years, which is actually good. It sounds like very tiny growth to someone not familiar with the utility space. I guess my question is your thesis basically that if you're picking and choosing stocks, will some utilities disproportionately benefit from that demand growth, and or are utilities investors just used to such slow growth that anything is better than nothing?
Yeah, it's funny. A lot of people will laugh, but utilities are exciting again. And when we talk
Boring is
about
beautiful to me
exciting,
too.
in utilities land, going from 1% electricity demand growth to 1.5% electricity demand growth is what gets us all throwing a party here. And as you've seen over the last, especially 9 months, but even over the last couple of years, the valuations have picked up. So not only are we excited in terms of stock buyers, but the market's getting excited and giving utilities a premium valuation relative to what we saw back pre-08. And we really like to, in terms of valuation, we like to look at pre-2008 when interest rates started going down. You had this ultra low period of interest rates. Now we're back to a period where maybe we're in a normalized, whatever your view of normalized is, interest rate environment, and investors and utilities can start looking at fundamentals. And there's no bigger growth fundamental right now than the potential for AI electricity demand growth.
I like that you mentioned pre-08 because for people who are newer to the market, maybe just got in the past 5 years, the period we've had is really like a long period of freakishly abnormally low rates. And it's kind of warped the laws of investing physics, at least I would argue. So I think you're correct to go back before that happened. But speaking of those newbies, someone coming into the space saying, I've never heard of utilities or haven't taken a deep dive into them before. Travis, what are some of the drivers that ultimately move either their operating performance and or their stock prices?
Yeah, the big thing you have to look at first is investment in infrastructure. And investment in infrastructure is the core thing that utilities do. That's their bread and butter. That's their job, is to have a system that delivers electricity, water, natural gas, maintain that system, make sure it's reliable, make sure it's resilient. If something comes through, a natural disaster, et cetera, comes through and knocks out the system, to bring it back online. It's an infrastructure heavy business. And that's ultimately how they get paid. When they charge customers, the rates that you pay on your customer bill every month go to support that infrastructure, and as well as pay for the energy you're using, natural gas, water, electricity. But the big part of the way utilities make money is simply building and maintaining infrastructure. That's why we get really excited in the utility space about the opportunity to build more infrastructure, make it stronger, reach greater areas geographically, make the pipes bigger. Essentially, if you're talking about electric wires, make them able to handle more and more electrons through them. This takes a lot of money, it takes a lot of infrastructure, takes a lot of expertise that utilities have that other companies can't just go in and build an electric system. So when you start thinking about AI, thinking about these data centers that are coming online, this is a generational type of infrastructure investment opportunity for utilities. We have not in the sector had large load, what we call large load of these data centers, these high intensity electricity consumers on the industrial side. That just hasn't happened in literally decades. So even the management teams, us as analysts, trying to figure out how does this translate? How does all this new demand translate into infrastructure investment and ultimately infrastructure investment that leads to earnings growth?
And those companies, I mean, you have to build new wires, you have to build new generation from time to time because they're natural monopolies. Utility, or at least the LDCs, the local distribution companies, the ones who are closely connected to the ratepayers and invoice them, they're monopolies. Some upstream players are not necessarily monopolies, but I guess my point is ultimately there's a very tight connection between the utility's profits and the regulation applied to that utility. And certain utilities in more favorable regulatory regimes have a lot better time with passing certain costs through their ratepayers than do others. And I'm guessing that the data centers are aware of this fact and have located accordingly. Is that ballpark accurate?
Yeah, no, absolutely. I think all of this new demand, all the infrastructure builds, really going to put a focus on local regulation, local economics. Not every utility is going to win. And there's going to be a lot of focus on which utilities can really work with a lot of different stakeholders here. You talk about working with Microsoft, Google, Amazon. That's one customer for utilities. Those data center builders, developers, users, that's a customer. That's a very large customer. When you think about utilities, you forget that they often have customers. There's actually a lot of customer service activity involved in dealing with a Google or Microsoft and Amazon. That's going to be a third or even a half of the total electricity demands in a certain region. In addition to that, they have to deal with all of the residential customers. They have to deal with regulators, like you said. A lot of times they have to deal with politicians. They have to deal with local boards and local landowners. So there are many, many stakeholders involved here. And as you add more demand to the system, as you bring on some of these very large customers, that just creates more risk essentially in the system and more people that the utilities have to deal with. So you're absolutely right. Regulation is going to be a key component here, how utilities deal with all of these customer groups and how they deal with regulators in terms of setting rates. And it can have a big impact. The way that they set rates in the utility space can vary by customer. So there is a scenario where utilities might have to prove to regulators that Google and Amazon and Microsoft coming in won't harm residential ratepayers. So you're going to have a little bit of tension potentially on that stretch. So utilities are really going to have to focus on regulation, focus on dealing and relating with all of these new stakeholders, especially as you get AI, data centers, even industrial manufacturing, as that comes back, onshoring of that, semiconductor, the CHIPS Act. There's just so many big macro drivers right now in terms of new infrastructure needs, new energy needs, electricity demands growth. And that is going to put a premium on regulatory relations and ultimately very local and regional regulations. So big focus.
So before we get to one of your very favorite utilities, which I know is probably the main reason a lot of people are watching this video, I want to ask about two acronyms first, EVs and IPPs. In terms of EVs, you wrote that the EV demand is actually bigger than the data center demand. We got everybody focused on the data center. We're all excited about that, but EV demand is bigger. How much bigger is it? And is it something people should think about in their investment thesis for utilities in the same way they would think about data center demand?
Yeah, I think you have to think about EVs in a different context. EVs are going to be a slow growth, and slow growth, growing at 2 and 3% is still a lot of growth for a utility. But if you think about the super growth type of ideas, EVs are going to grow gradually. That's probably a better word. They're going to grow gradually. We know it. We can see the car sales numbers. We can see the enthusiasm around EV car sales, manufacturing. There's a long supply chain, and we can see that. We got a good idea of what that trajectory is going to be like on the electricity demand side. Utilities are getting really, really good at managing EV load. This is not like 10 years ago when EVs were brand new and utilities were trying to figure it out. Utilities know how to manage EV demand growth. Data center demand growth is going to be very lumpy. That makes it very hard technically for utilities to handle it. And we just don't have that much large load. Like I was saying earlier, we haven't had a large load customer group come into the US in an energy intensive way in decades. So utilities are really trying to figure out this data center thing. If you look at some of the most bullish forecasts, data centers ultimately, say over the next 5 to 10 years, get to about the same level as EVs. That's in a very, very bullish scenario. That's if utilities can figure out how to connect all of these data centers and meet all of this data center demand. If they can do that, data centers and EVs will be about the same. If they can, if there are hurdles along the way, if data center development has to slow because there just isn't access to as much electricity, if utilities aren't able to bring these data centers on in a reliable way, EVs will continue to outpace demand growth for AI and data centers. So that's the real tension we're looking at right now on the growth side. EVs, we know, is going to be a steady and fast relative to all other electricity demand. It's growing fast, and utilities are having to deal with that. The data center demand is a real uncertainty right now. If it does grow in the most bullish forecast, it will surpass EVs. If it doesn't, EVs are going to far surpass data center demand.
Interesting. So it's maybe a decade out, and it may not even happen. We don't know it. Interesting. On IPPs now, you mentioned those big data centers. A friend of mine, Enrique Abeda, was talking on our show a couple of weeks ago about this Talon Energy, which is one of several of these IPPs, and they're all roughly similar. They create power independently. They're largely unregulated, and they sell it into the grid or sometimes to captive customers. And he's, of course, bullish on Talon, and that was a very popular video segment we made with him. However, one thing he mentioned was that Talon almost signed a deal with Microsoft, if I'm recalling correctly. Some of these big tech companies, not just Microsoft, but the others, I think they're all trying to lock in these power deals with IPPs, sometimes going out 20 or more years, like buying all that power. Now, that's obviously, in one sense, good revenue visibility for these IPPs. I'd wonder, though, how state regulators might look on that, because in theory, if you're making cheap nuclear power and then this data center, big tech buys that up, and the benefit of that cheap nuclear power is not going to the ratepayers, maybe state regulators aren't too happy with that. What's your take on IPPs writ large?
Yeah, we think the market's gotten way over enthusiastic. At a simple level, like you said, if you own a power plant and more people are using your product, it's electricity, prices go up, margins go up, and it should be a big win for you. The problem is there are layers of regulation, and even though the operations themselves might not be regulated like your traditional utility, the IPPs do still face regulations. A key part of that is getting an agreement, like you were implying, an agreement to be able to sell their power directly to a customer rather than sell their power to a distribution utility, which can then sell the power throughout the residential and commercial sectors. So we're waiting on a big decision, what we think will be a critical and precedent-setting decision from the Federal Energy Regulatory Commission later this fall regarding that Talon deal. It's very, very possible, and there have been opposing parties who have said this is not fair for Talon to contract directly with a data center or any of the IPPs to contract directly with a data center. This isn't fair to all of the residential and commercial customers, the distribution utilities that used to get that power and be able to distribute it throughout the grid. It's not fair for those IPPs to now have one customer and be able to sell that power to that single customer. The other side is an interesting situation with reliability. These data center customers, they might have one contract with an IPP like a Talon or other IPPs, but they still want connection to the grid. Yet they're not paying for the connection to the grid. So this has got a lot of distribution utilities and especially some customer groups saying, hey, you can't have it both ways. You can't have one single contract with one power plant taking that off the grid and still have access to the grid such that you still have power when your power plant goes down. That's just not a fair situation, is what their argument is. And ultimately, what we'll hear from the FERC is whether or not that's a fair argument. The FERC has to sign off on contracts like this between power plants and data centers or any other large load customer. FERC has to sign off on that. There's usually not been controversy around those types of contracts, but I think there will be now. We've seen some opposition to it, and ultimately, I think this fall we'll find out. There's been a lot of excitement to bring it back to the markets. There's been a lot of excitement that these IPPs can sign these types of high profit contracts with the high demand customers. It's a very, very good thing for profits for IPPs. We'll see what FERC says. And this will be a precedent that could pop the balloon, some of these very inflated valuations that we've seen.
Yeah, I think I forgot which utility ETF I was looking at, but it had underperformed the S&P so far year to date, or not too much, but the IPPs have way outperformed, many of them up 50%, 75% or more. So yeah, you're right. If things don't go in their favor, that's a big balloon to pop. Okay. So if someone says, okay, IPPs are too spicy for me, I just want something in the plain utility space, Travis, where would you send them, or what ideas might you have them to look at?
Yeah, I think the data center theme is a really good one still. I just think investors need to think locally. They need to think this is not an industry-wide type of phenomenon. This is not going to lift all utilities. Data centers are going to be very local, and there are only going to be a few winners here. Those winners are going to be utilities that can manage the load, that can hook up the data centers, have the expertise, and then also, I like to have all, again, back to the whole stakeholder discussion, have stakeholders that are on board. They have regulators that support it. They have politicians that support it. They have a workforce. They have an infrastructure that can support it. So one of our top picks right now is NiSource. So they have an electric utility in Northwest Indiana. They also have gas utilities. So they're about half gas and half electric. Their gas business is doing very, very well. It's a very steady cash flow producing, very typical utility type of business. So you've got that one part of the business supporting a lot of cash flow, supporting the dividend. The Indiana business in electric is where there's potential data center upside. They've already got one contract with Microsoft to put a data center in LaPorte, Indiana, which is in the northwest corner of Indiana. If they were to get that data center and one or two more data centers, their projections that they've given to regulators is that that could double the amount of electricity demands in their region.
Wow.
That's huge. So that's not only going to require more infrastructure, it's going to require a lot more expensive infrastructure. And that's good for earnings. What's good for residential customers is you have all of this new demand coming into the system that could actually lower residential rates.
Yeah.
So you, in a lot of ways, have a win-win potential here, and it's going to be material. A lot of the other large cap utilities that we see are going to have 5, 6, potentially 7 data centers. They need a lot more to move the needle. When you have a utility, a large cap utility that operates in 3 or 4 states, covers millions of customers, they're not going to benefit as much from 1 or 2 data centers. NiSource, we think, has a lot of upside and a lot of leverage, operating leverage, to getting 1 or 2 data centers. And that's why we think it deserves a premium. It trades right in line with the group right now, but we think it deserves a premium valuation.
Yeah, the ticker is NI. It's up 18.7% year to date. I'm just looking right now as we're recording. About a 14.4 billion market cap, 3.3% yield. So not a huge yield, but at least relatively solid. Yeah, I'm sharing the screen here. Relatively solid for a utility, certainly above the S&P 500 average. And so, Travis, if someone is looking at NiSource right now and saying, okay, I'm interested, and I've got a 3-year, a 5-year horizon, something like that, do you have any ballpark idea of what kind of returns they might expect during that time?
Yeah, we think the stock right now is about 10% undervalued, and we would typically think about a utility as returning about an 8% return in a normalized environment. This is absent any huge moves in interest rates, that's obviously going to have a big impact on what total return.
And 8% doesn't sound sexy, but for the risk you're taking, it's a pretty good rate because it's safer than the average S&P stock.
Yep. So again, 8% in a normalized environment is what we would expect from a utility. Since we think NiSource is undervalued at the current price, we think that investors can assume a 9 or even a 10% type of total return that includes the dividend yield. So when you're thinking about stock price appreciation or capital appreciation, that'd be more like 6 or 7% annually. And again, this is a trend for NiSource and for several other utilities that could last 5, even 10 years by the time they build enough infrastructure to be able to serve some of these data centers.
Yeah, it's for a utility, that's a pretty good rate. And the case sounds pretty compelling in that, they're not a company, I don't know, like Dominion that's got a lot of other data centers is one more drop in the bucket. This could really move the needle for this company. And I'm guessing it's interesting because, Illinois compared to Indiana is such a difference in the regulation, even though it's right next door. The NiSource is going to play up the fact that their ratepayers can end up with lower rates potentially. And if I'm the state regulators, I've got to like that. So it sounds like in general, it's a more positive thing for them. So this is not something to replace NVIDIA, or some high-tech moon rocket in your portfolio. This is something that could be a bread and butter cornerstone type of holding, not too exciting, but also not likely to go way down either because everybody needs power and utilities. They have gone bankrupt, but it's very rare. And California found that out. If you're too hard on them, they go bankrupt. And that's not good for the ratepayers either. So there's a level of safety there is what I'm getting at. I'm guessing you concur with that, Travis.
Yeah, no, absolutely. And even for NiSource specifically, you have to remember that half of their business is the gas distribution utility. And gas is a very steady cash flow producing type of business. A lot of infrastructure, they earn that on that infrastructure. They have good relationship with good relationships with regulators in the states it serves. So with NiSource, you do have that business, very steady cash flow, very typical utility-like business. And then you pair that with the 50% other side of its business, that's the electric distribution that we think has a lot of growth upside there. So you put those two pieces together and we think it's a pretty compelling story for a utility with 3.5% yield or so right now and should trade at a premium multiple.
Speaking of compelling, Travis, you're very compelling. You certainly sound articulate and like you know your stuff. If somebody watching this says, all right, I like NiSource, I'd like to learn a little bit more about Travis Miller and or Morningstar, where would you send them?
I definitely encourage you to check out Morningstar.com. So it's our platform for retail investors and also advisors. If there are advisors out there who are more interested, there's contact information on Morningstar.com. You're certainly more than welcome to contact me. I can put you in touch with the right people for our advisor type products and our institutional client type products.
Excellent. We'll put some links in the show notes and maybe flash something on the screen as well. So Travis, I'm going to check out NiSource. I'm guessing I'm not the only one, thanks to your sound counsel on this. Thanks very much for taking some time to speak with us today. And thanks to you guys, as always, for watching us at home.